Hey, good afternoon, everybody. Welcome to U.S. Home Talk. We are your podcast for real estate and mortgages, talking anything and everything dealing with real estate, mortgages, all the current event stuff that you hear and see out there in the media. We like to bring those things up, talk about them, and answer your questions as well. So you can join us live on our shows, or you can look at all of our past shows too at our website, ushometalk.com. There you'll find everything. Our past shows, you'll find free reports on buying, selling, all a bunch of information there. So go ahead and check us out at US Home Talk there. And then you can also connect with us during the week as well. On the show with me today are my two hosts here. We got Marcus Walgrave with the South Dakota Home Team, powered by Head Realtors. We have Jason Walgrave, Walgrave Real Estate Group, with Remax Advantage Plus. And today we are talking about home loan programs you did not know existed. Okay? This is an exciting show. Everyone loves talking about finances, right? Everyone's a numbers person. Everyone loves talking about financing. I know, so this is going to be like a record show. We're going to get record views on this one. I can feel it. All right. So today, home loan programs you didn't know existed. Okay, we all know the traditional box out there, right? We got your traditional, you got your conventional loans, you have your FHA loans, you got your VA loans for our vets out there. I love the VA loan program. I think it's the best one out there by far. We have your USDA loans, which is a rural development program, right? A lot of people don't know about that one, but that is out there. But those are your standard kind of core 4 type of loans, okay? But they all have one thing in common. You got to qualify traditionally, which means you have to show the income needed to qualify on your tax returns, on your W-2s, on your pay stubs, things like that, okay? The programs we're going to be talking about today, and most of the programs we're talking about today, are for those people that have the good credit, you have money to put down, but you don't show the income on your taxes, okay? Well, does that make you a bad borrower because you don't show your income on your taxes? Mm-mm. You're clearly not a bad borrower because you got excellent credit and you got a bunch of money to put down. So it's not like that just happens, right? It's not like you just open up your, you found this brown paper sack on the side of the road and it's like, hey, this sack just gave me an 800 credit score. Sweet, right? Yeah. That just doesn't happen on accident, right? Credit scores, that's earned. Your credit score is earned. Saving money, having money to put down, that's you've earned that, right? So, but there's certain, obviously, IRS rules as far as your taxes go to where maybe you don't have to file and show that income on your tax returns. So then how do I qualify for these traditional programs where I got to show my income on my tax returns in order to qualify for them? Okay, sometimes that's a hurdle. So how we skin that cat is we can go to some of these alternative documentation programs. Okay, so the first one I'm going to talk about is a bank statement loan. Okay, so we have bank statement loans out there. What is that? That's for your self-employed borrowers. Maybe you're just a sole proprietor, right? You have, you got your home business that you run out there. Maybe you're a photographer, right? And you work with Jason and Marcus on listings, right? You do all real estate photos. You do the photography for their listings. You do the drone stuff for their listings. That's your business. You got that business going on there, okay? Mm-hmm. So you have that business. You got excellent credit. You got money to put down, but you can also write off a lot of your expenses there, and you don't show the income needed on your taxes to qualify for one of these traditional programs. Mm-hmm. But you have a lot of money coming in. So let's say you have $25,000 of deposits coming in every single month because you have a lot of high-end listings that you do. You got to work with a lot of real estate agents. Maybe you have a little small team underneath you or something, and you got 25 grand coming in. Well, what we'll do is we'll do a bank statement loan program, okay? We don't look at your tax returns. We look at your business bank statements and we look at the deposits coming in on those business bank statements. And then we use a percentage of those deposits coming in your business bank statements, and we take an average over the last 12 months. Okay? So the average over the last 12 months is what we get to use now for monthly income to qualify you for this particular loan program. Okay? So real life example, I had a guy that owned a delivery business. Okay? He had a couple single cars, right, that would take small packages. He had a box van that he had for larger ones, and they had one semi. Okay? If I went through his tax returns and calculated how much income we could use on his tax returns for one of the traditional programs, right, he had $1,500 a month of income I could use to qualify. Okay? That's not going to, you're not going to get qualified for anything, right? Okay? Now I do the bank statement program. Okay? I do the bank statements. I got his 12 months worth of business bank statements, calculate the income. Guess how much income I had for him now to use on a monthly basis, monthly income to use to qualify.
20?
10 grand.
I had 52,500. What can you qualify for with monthly income of 52,500 a month coming
Pretty
in?
much whatever you want.
Whatever you want. Okay? So that's the power of these programs is under the traditional stuff, right? Under the traditional programs, he had no shot at qualifying and getting a mortgage. Okay? Now when you get into these alternative documentation programs like this, now he can buy whatever he wants. And he's clearly a good borrower. The guy had like $2.5 million of gross revenue coming into his business a year.
Jeez.
Okay?
Wow.
He had the great credit. He had money to put down. He just didn't show the income on tax returns. We had a solution for him. Okay? So let's go to the next one. Another one is a 1099 only program. This one is great for real estate agents. Okay? Most real estate agents are 1099. Okay? So on this particular program, again, we don't look at tax returns. We don't look at them. Okay? We look at your 1099 that you get from your brokerage at the end of the year. We take 90% of that 1099, and that's what we can use to qualify.
Wow.
So if you're a real estate agent making 150 grand a year, your 1099 comes over, you grossed 150 grand. We could use 90% of that. I have now 135 grand a year of income to use for you to qualify on that program.
That's fantastic.
Does not matter what your tax returns say.
What kind of interest rate? So let's say traditional, just for easy numbers, let's say traditional conventional rate is at 6%. What would, good credit and all that stuff, what would the rate be on this program? Because it's got to be a little higher, right?
It's a little bit higher, yeah. Whenever you get outside of the traditional box, and this is going to be a longer answer, but I will circle back around to it, okay? You're out when you get outside of the traditional box, right? That the traditional conventional FHA box, right? That I was talking about earlier. Anytime you get outside that box, your rates are going to be higher. Your down payment requirements are going to be more. Your interest rates are going to be higher. Okay. Now, the one thing our government does right, is setting interest rates and having 30-year fixed loan programs. If we did not have our federal government involved in the mortgage world, okay, we wouldn't have Fannie Mae, we wouldn't have Freddie Mac, we wouldn't have FHA loans, we wouldn't have VA loans, we wouldn't have USDA loans. Okay. What you would have is you would have banks like, let's just say some big box banks. You would have the Wells Fargos, the U.S. banks, the Bank of Americas. You could still go to those banks and get mortgages. You're not going to get a 30-year fixed. You might get a 30-year loan, but the rate is only going to be fixed for 5 years, and it's going to adjust after that. They're all going to be adjustables.
Right.
Okay? And they're all going to require probably a minimum of 15 to 20% down. Okay? So the government stepped in and made these programs, right, so that we could get in a conventional loan on a 30-year fix so as little as 3% down. We could do an FHA loan with not as good a credit out there with only 3.5% down and still get a 30-year fixed at a 6% rate today. Okay? So that's the one thing that our government got right. The thing that our government didn't get right is, hey, this is how you have to qualify. You have to show the income on your tax return. Okay? Right. That's where these other programs come into play. Okay? So these other programs, the government regulates them, but is not like directly involved in setting the rules for them. Okay? So it's like investment companies, things like that on the back end that are setting the terms and setting the rates and setting the requirements for these particular programs. And the government says, hey, we'll allow you to do these as long as you can document the ability of that particular client to repay the loan back. Okay? So then they just got to make sure they meet the government's requirements of the ability to repay. So as far as interest rates go, right? So this is outside of the traditional box, things like that. The one guy that I was talking about that owned the trucking company, okay, he had 40% to put down. He had a big down payment, okay, and he had really good credit. I got him a 6.75 rate on a 30-year fixed.
Dang.
Okay?
That's incredible.
That's awesome.
Right? Now, if that same borrower had 10% down, if he had 10% down, his rate's closer to 8 to 8.25.
Okay.
Okay? And now if you have a little bit, if you weren't top tier credit, but you still had like your 700, 710 credit score and 10% down, which is the minimum on these programs is 10% down when you're buying a primary residence, he probably would have been at 8.5, maybe 9. Okay. So his top tier credit and his big down payment got him down into the 6s on a 30-year fixed. Yep. Some people might be 8.5, 9 if they're a little bit less on the credit scale and they have less down.
Yeah.
Mike, does it? Go ahead,
Go
Jason.
ahead.
Sorry.
Go ahead.
I was just gonna say, the one example is the 40% down, right? I mean, is it like once you get to 20 is perceived to be the same as 30 and 40, or does it still kind of like the more you put down, the closer you're gonna get to a traditional market rate?
Yep, the more you put down. So I ran his numbers. I showed him here's what 10%, 20%, 30%, 40% looks down because he wanted to see the scale. He did get a drop in his interest rate with each chunk. Now, once he hits 40% down, 50% down, everything else from there on down is going to be the same. But we looked at 30% versus 40%, and he still gained a quarter better interest rate. And he's like, I got the money. I'll take the lower rate. I'll put the 40% down and, and save myself some money there. So
I think what's interesting is that most folks don't realize that these programs are available, and because you just, you kind of think, oh, I got to put, 20% down, and I got to have great credit, and I got to be able to show W-2 tax returns, and, because that's what's, usually that's out there, right? But, we've, on all the years we've been doing this, and it's been a few years, we've always said, and this is true, that if you want to buy a home, regardless of the position that you're in, we can show you how to do that. We need time and a plan. Right. And so even if that means, you just went through a foreclosure or a bankruptcy or whatever the case is, it might take some time to get there, but we can create that plan. And if you follow it, maybe it means we gotta work on your credit. We got to rebuild your credit. Maybe it's you got to save up X amount for down payment. Anybody that wants to buy a home, we can help you get there with time and a plan. Mike at Luminate, you guys have products that most don't. We also have contract for deed partners that we work with that we've had situations where people have just went through a bankruptcy like 2 months ago, or they lost their job and their credit is shot and, everything went to heck but they acquired a new job and they're making good money and they've got some cash, right? And so there's, with the programs that Luminate has and with the other partners that we have out there, it's incredibly unlikely that we can't get you into a house very quickly. Worst case scenario, it's going to take time and a plan. And that's what we're here to do, is help people achieve their real estate and home buying goals. And we can get there with time and a plan.
Now, before these programs came out, what we would do traditionally, right, for the self-employed borrowers, right, what we would do is say, hey, here's what your tax return looks like now, right? Here's the income you show. Yeah. If you want to buy a $400,000 house, you're going to have to show this much income on your next 2 years worth of tax returns, okay? Because that's the income you need to show to qualify for these traditional programs that were out there, okay? So now you got to show the higher income and you're waiting, and now you're paying the income tax as you show more income, okay? So now these programs come out and you get a self-employed borrower. It's like, okay, here's your two options. You can either show the income on your tax returns for the next 2 years, right, and hold off for 24 months before you buy a home. Okay, and then pay the income tax, or we can go with this program over here, right? And maybe you have 10 to 15% down. Your rate's going to be 8%, and they're like, "Well, 8%? That's just too high. I'm not going to pay 8%." And I say, "Well, here's your comparison. Okay, how much are you going to pay in taxes, income taxes, for the more income you're going to show on your tax return, so that you can wait 2 years and get a 6% interest rate?" Well, I'm going to be paying a lot, right? And you work the math, and it's like I'm going to be paying 35% of what that gross is that I got to show. Okay, well, how much more are you going to pay on an 8% interest rate versus a 6% interest rate?
Right.
Okay, I'm going to pay $350 more, let's just say, or $300 more. Well, what's cheaper, right? How many thousands, tens of thousands of dollars you got to pay in income tax, or paying an extra $300 a month?
Yep.
And by the way, that $300 a month, you get a reduce, right? That's a mortgage interest. It's a deduction on your next tax returns that you file, right? So now you got to pay even less taxes on your next future tax returns coming up. And I show them that comparison, and then the light bulb goes off, and they're just like, I would be happy with that 8% interest rate. Yeah. Let's do it, right?
Yep. And history has proven that the value of that home is likely going to increase. So you get to cash in on the 2 years of owning it instead of the 2 years waiting to own it.
Yeah.
So there's a lot of compounding benefits.
And just to bring some additional clarity to Mike's comment about showing the income on your taxes, and what does he mean? Well, what he means is that as a business owner, you have eligible deductions. write-offs because you're doing business and you can reduce your taxable income because of the available from the government, from the IRS, the available write-offs. Well, it means not taking those deductions, not taking those write-offs to show higher income, which means you got to pay more taxes on it. So it is, it's about, and Mike, that example is fantastic because it's, I don't want to pay 8%. Okay, well, you pay 6% over here, but you can't take those deductions because you got to show the income, which means you're going to have this massive tax bill, or you pay a higher interest rate, which is $300-400 a month more, which comes out to be what, $4,000 a year. Well, just think you can refinance in 2 years anyway, right? And so I mean, there's there's different options, but you just Mike, you do a phenomenal job of breaking down the numbers, showing it side by side. Okay, what does this mean? What's my bottom line? What's the cost and the monthly cost? And then you can make the decision what's best for you.
Exactly. Yeah, we're going to go to a legal minute. There's another one coming up here that we're going to talk about. It'll be the last program that we're going to talk about today. It's for investment properties. It's kind of unique, but not unique, and I'll explain what I mean about that. But we'll go to legal minute first, and then we'll come back and talk about it.
This is Jeff O'Brien, attorney with Hush Blackwell, with the U.S. Home Talk Legal Minute. Several Minnesota cities require truth in housing inspections prior to the sale of a home. In Minneapolis, for example, a truth in housing evaluation is needed for any sale of a single-family house, duplex, townhouse, or first-time condo conversion. The report needs to be done within 3 days of offering the property for sale and before it can be shown to prospective buyers. The evaluation can only be done by a Minneapolis licensed evaluator. The evaluation covers certain items and identifies required repairs. Copy of the evaluation report, the certificate of approval if issued, and the list of repair items can be found on the city's property information website. The truth in housing evaluation must also be displayed on the property so potential buyers can view it. Repairs must be made when a house is sold. Buyers must sign the acknowledgement of responsibility unless a certificate of approval has been issued and file it with the city of Minneapolis within 1 day of the closing. The buyer then has 90 days to complete all required repairs. After the repairs have been completed, a reinspection must be done. Before you list your home for sale, be sure to check with your city to find out whether you are required to have a truth in housing evaluation performed. This is Jeff O'Brien, attorney with Hush Blackwell, with the U.S. Home Talk Legal Minute.
Thank you, Jeff. Very good info. If you are a home seller out there and you're like, what is Jeff talking about? This truth in housing, I got to check with them. Your real estate agent will do that for you. So just plug in with the top agent. They will take care of that. You don't have to worry about it. So, okay, last loan program, the loan program that you didn't know existed. Last one we're going to talk about today. It's called a DSCR. Does anyone in the room know what DSCR stands for? Evan, you can answer too.
Disker.
Debt service something.
Yep. Debt service coverage ratio.
There you go.
Okay.
It's 50% right.
50% right. Okay. And so this is a newer program on the residential side, but to be honest with you, if anyone has done any commercial out there, this type of qualifying has been around for years on the commercial side. This is how commercial properties and commercial loans are done. This is how they qualify, right? Finally, the light bulb went off with someone and be like, well, on investment properties, an investment property is like a commercial property. I got a payment that I need to make to keep this thing, and then I got to have income coming in from my renter, right? Just like a tenant in a commercial building is the income coming in. So why can't we just do the same thing on the residential side of things? Mm-hmm. Makes sense. Let's do it, right? So you come up with DSCR loans, right? We don't look at tax returns. We don't look at your income. I mean, these are the easiest loans to qualify for, to be honest with you, as long as, again, you got the credit and the money down, okay? All we do is look at the property. How much rental income is that property going to bring in, okay? Let's say it's $3,000 a month. Okay, you need to put at least 20% down on the property then, and then you need to put additional money down if you need to get your monthly payment down to $3,000. Because all we care about is that if this property brings in $3,000 a month, we want the monthly payment on this thing to be $3,000 a month or less. And if you can do that, you qualify. Doesn't matter what other houses you have, doesn't matter what other debts you have. We're looking at this specific house. As long as the income coming in on that thing is the same or greater than the monthly payment that needs to be paid on it, we're going to give you that loan.
It's fantastic.
Makes sense, right?
Yep.
Now these people got to have money down, right? You still got to have the money down, just like all these programs out there. Still got to have the money, still got to have the credit. Okay, you got to every single loan program you got to have the money and the credit. But as long as you have that, now you qualify using this, and it's great.
It's awesome.
Do they have a lot of like limits?
Yeah. Limits on how many of those loans you can have?
Nope.
Or the dollar amount of the loans?
I literally have a guy right now that looked into this. He says, like, there's $1 million property that I might want to buy on this. Now, it was in a market where it's just higher. Like $1 million here is like your average price, right? It's a Florida market.
Right.
$1 million, like your average price of the home there. So it's not like you're buying $1 million home in Hardwick, Minnesota, and trying to rent it out to get it, to qualify, right? So it's higher dollar amounts, it's higher rents coming in, it matches the market there, right? And so I said, no, there is no loan limit. If you want to do $1 million, you got your 20% to put down. That's the minimum you can put down on this thing. So if you got your $200,000 that you're going to put down plus pay your closing costs, and you want to buy this $1 million home, we will qualify it the same way. And if it qualifies, you're good.
Residential properties or commercial, both?
This is it's on both. I mean, I'm talking about residential because I do all residential stuff. But I mean, the DSCR ratios, right? That we're talking about how you qualify. This is how commercial loans have been qualified for years. Like way before I even got in the business, which was June of 2004, right? So it's just finally like it's like the light bulb went off of like, well, if you do that on the commercial side of things, why can't we do it on the residential side of things, right? And so these programs now exist today because of that.
Love it.
So
time and a plan.
Time and a plan, right? It's the thing. Make a call to someone.
Yeah.
Here's the deal. I got credit and I got money, but I don't show the income. Like, can I do anything? Right?
Yeah.
That answer is you can't.
Don't assume the answer is no.
Yep. Make a call to your real estate professional. They start with number one. They have a network of connections, just like Marcus, just like Jason. They got a network of connections of like, hey, I might not be the guy to get you that answer, but I know a guy, right? I got a guy that does this. Let's get him involved. Let's get that answer for you. So
love it.
All right, folks, we appreciate you tuning in today. We will be back next week with another show. Check us out at ushometalk.com. All our previous shows are there, or any other podcast service you use. On behalf of Marcus Walgrave and Jason Walgrave, I'm Mike Overson. We'll see you next week.